Hey guys, welcome back to the channel. So I think one question that's been coming up a lot lately for 2025 is whether we're going to see a rotational market or a continued momentum market. So I wanted to go over some strategies, not knowing exactly what the market's going to hold, but knowing that there has been volatility. So how can we create a portfolio that's defensive in this volatility, but also still captures momentum? Because as we've seen, like the Mag 7 stocks still continue to outperform much of the market. They're volatile, but they continue to drive a lot of the growth. So we don't want to abandon our strategy with large tech stocks, but knowing that they've really increased over the last year or two, how can we make sure that if we experience major volatility, that our portfolio is still positioned to weather the storm? So I'm going to go over a few different places that we can sort of invest in this market that might be helpful, given that we don't know what's going to happen with stocks. Um, so if we are going toward some amount of rotational investing, this just means that stocks that have been out of favor in the past might rotate back into favor. And so I've gone over some of these charts showing various asset classes and where they've moved in the past year. And a lot of that's been focused on the US equity markets. And within the US equity markets, we can look at different sectors that have underperformed and different market caps that have underperformed. And so one potential strategy is to look at sector rotation. And so I've sort of gone over this in other ways, but if we look at sort of the trailing performance from the last year, we can see that a few of the sectors have outperformed and a few of the sectors have underperformed. And so focusing on sectors that have underperformed might be helpful in making sure that your portfolio is positioned for a rotational movement. Some of these asset classes are, industrials, materials, financials, and energy. These are sectors that just haven't done as well. And I always recommend, again, Vanguard funds because they're going to give you exposure to many different stocks within these sectors. And so these are sectors that just haven't done as well. And so they have, as prices have continued to climb in other sectors, these sectors have more attractive valuations because they haven't grown as much. So as we rotate out sectors, we can look at the performance, and we can also just look at sectors that have traditionally done better in sort of a more volatile climate. And so those are sort of defensive sectors that, always are needed and are sort of like have more consistent revenue because of the fact that they're a little bit less price sensitive during times of inflation or times of growth or contraction. And so we can look at a few different ETFs by Vanguard for sectors in utilities, healthcare, and consumer staples. These are sectors that are just always going to have consistent returns because they're not sectors where that depend on the economy growing a lot. Certain sectors will grow much more if the economy is hot, but some sectors are just always going to be around. People are always going to need energy. They're going to need to pay for heating. They're going to need to pay for electricity. They're going to need their healthcare. Consumer staples are just things that people need all the time. So sort of our first strategy is to, rotate into sectors that are both defensive and sectors that have not done as well in the past year. And so these are the sort of, I'll like put up a lot of these Vanguard ETFs, which again are very low cost and will just give you exposure. So, if your portfolio right now has, broad market exposure, it might not be the worst idea to just purchase a few sector ETFs. So the second potential investment we can make is just to rotate into more value-oriented stocks. And so obviously we've seen that growth stocks have done really, really well in the past year, way outperforming the market. If we look at the sort of Vanguard Mega Cap Growth Fund, it's done better than the S&P 500 overall. So there may be a potential for value stocks which have underperformed the market to do better in a more volatile environment. Again, value stocks generally will do better in a volatile environment. Again, as the name suggests, they're sort of like better value. So they're not dependent on huge growth. So if there is sort of like a slowing in the economy, they're not going to be as impacted as much. So there's a bunch of Vanguard value ETFs that you can use. There's sort of a broad market ETF, VTV, which is just their value ETF. And you can go into the mega cap stocks too with MGV, which is instead of a growth, it's a value oriented ETF dealing with really big companies. Again, you can also grab different ETFs. Vanguard has ETFs in mid cap and small cap and large cap that are value focused. And this will just, help create a little more defensiveness in your portfolio. That's not to say you should abandon your growth stocks because, again, we don't know whether this is going to be a continued momentum market. So I would say just increasing some exposure to your value stocks might be helpful in weathering some of the volatility. The next thing I would say is you can focus on sort of dividend ETFs. So sort of like larger, and these are going to be more value oriented stocks. And so there are a ton of different Vanguard dividend ETFs that you can purchase. But you can just look at sort of like tried and true. I did a quick video on aristocrat stocks, which are stocks that have continuously increased their dividends over time, and those are just like blue chip stocks that will continually pay out high dividends. This again is a focus towards value, but it's also a guarantee at some amount of income, and that just really stabilizes your portfolio. You're not looking for massive growth, which you will get obviously with a lot of these tech and growth stocks, but you are getting the consistent income that the dividends offer. And so obviously this isn't going to grow as much in a growth market. So if momentum continues, these stocks are not going to do as well. But if, momentum sort of pulls back, you'll still have sort of this steady growth that you get from these value oriented dividend paying stocks. Okay, so the next thing, again, we were talking about you could have sector rotation, but you can also do market cap rotation. As we found in the last year, the really high performing stocks were mega cap stocks, really large cap stocks. You can attribute a lot of the S&P 500 growth to just a few companies that were in basically tech growth. Stocks like NVIDIA really drove performance in the market. And that just means that mid cap and small cap stocks didn't do as well. But as sort of interest rates fall, small cap stocks might do better. And just with valuations being lower and growth not being as strong in the small cap and mid cap space over the last year, there's just room for more growth. And if you see, just some amount of economic expansion overall, we could see small caps and mid caps really growing because really growth has been focused on AI for the last year. And that's really favored these giant companies that have huge investments in AI. So that really is talking a lot about the US market. And obviously the US market has driven so much of the growth overall. But, as we've seen in the last couple of years, international markets haven't done as well. And this is for a variety of reasons. Obviously, the US market is just really strong and the economy is really strong. Economic policies have allowed for incredible growth, but that has left sort of a lot of the international stocks as more of a value-oriented position. So increasing global diversification could be another way to sort of weather the storm if there's increased volatility in the US markets, and if you just want exposure to other places. And Vanguard offers, a number of really good low-cost ETFs that give you exposure to the international market. VEU or VEA are both broad international ETFs, and VWO is more emerging markets, so that'll have slightly higher volatility, but potential for higher returns. Again, these are companies that you've probably heard of, but they're just based internationally. A lot of those larger mega cap stocks outside of the US will have similar sort of trajectories as big US stocks too. But again, just like with value growth, with sectors, there is a bit of rotation that happens, and there's cyclicality to a lot of these stocks. So it's never a bad idea to have exposure to some of these underperforming stocks. Okay, so the next thing I'll talk about is sort of commodities and real assets. And so these haven't done as well. And I sort of talked about this within sectors. The energy sector hasn't done very well compared to a lot of the other sectors. So there may be room for growth there. The energy ETF by Vanguard will invest in typical sort of like oil and gas companies. And as inflation grows or the economy expands, like people will need to purchase more energy. So those are sort of ways to get exposure to overall growth in the market, not just growth by these like select few large cap, mega cap companies. Commodities can also include gold, rare earth metals. So you can purchase sort of ETFs that are related to those types of commodities. There are a few gold ETFs that you can purchase. I know Vanguard has a precious metals and mining mutual fund. That's another area that just tends to keep more value during volatile times. People just see it as sort of a source of stability during uncertainty. And then on top of that, you can purchase sort of assets like real estate. And again, I went over sort of real estate investment trusts, REITs, and there are some Vanguard ETFs that invest in a whole host of REITs. Those two funds are VNQ and VNQI, which is the international version of it. Real estate, again, has really underperformed compared to a lot of the other sectors. So purchasing some of those might just be a good way to, again, rotate into that sector. Finally, I would just say, like, if we're looking at volatile times, now might be an appropriate time to rotate into bonds. Again, bonds are not going to be a source of huge growth for your portfolio. Again, like, you're never going to keep up with the returns of these tech stocks or these growth stocks or stocks in general. But if we're looking at super volatile markets, bonds can be a way to just hedge your bet. It'll give you consistent income over time with limited volatility. And so you can use it as an opportunity to rotate into that value of those bonds that have underperformed in the last few years. But you can also use it as a place to sort of like strategically place money and then rebalance your portfolio when there's a correction in the market. So let's say you want to sort of purchase bonds now, but when there's maybe like a pullback in the stock market, you can allocate that money back into the market. So you're moving, between different risk classes. Overall, like, we just don't know where the market is going to go. There's certainly like a case to be made for the fact that like momentum will continue. I think most people are of the opinion that whatever's driving AI, we're only in the first stage of that. We still have a long way to go. So those stocks are still going to be big drivers of growth over the next couple years. So you don't want to rotate out of them completely. I would just say, like, you want to hold on to those bets, but as new cash comes in, I would say it might be a good idea to allocate some amount of money outside of those. And if you've been invested in these AI stocks or these really tech-focused growth stocks, your portfolio probably has gotten a pretty sizable exposure to them. And so now might be a good time to just think about rebalancing towards some of the other assets that have gotten a little like smaller in your portfolio. So overall, there may be a rotational factor to this period in the market, or there may be continued momentum, and we just don't know what that's going to be. But having some exposure to sort of both sides of it might be helpful to allow you to take advantage of sort of like some of the market moves. And then when the market does move, you can allocate some of that money to underperforming stocks. I hope this video is helpful as we go into 2025. And let me know if you are sort of like what you're thinking in terms of your portfolio allocation.